So how does this actually link with the forward rate? Well, previously we had defined the forward rate very analogously, except we called the forward rate sort of its own thing. Here now we think about the expected rate a year from now that we can also pin down using 1-year and 2-year maturity bonds. Therefore, essentially what we're saying is that the forward rate is the expected interest rate 1 year from now. So let's look at an example of how we can actually pin down these holding period returns and how we can actually ensure that they will be the same across time. All right, so let's describe how the expectation hypothesis works. Let's say we've got our spot 1 year rate of 2%, and we've got our expected rate 1 year from now for 1 year of 4%. First of all, what should our spot rate for 2 years then be? Well, let's see what it would be according to the expectations hypothesis, and then let's show that if that rate actually is true, then indeed the holding period return would be the same no matter what investment strategy you pursue, which therefore would make that the right rate. So according to the expectations hypothesis, the longer term rate should be, specifically the 2-year rate, would be 1 plus the spot 1 year rate compounded by the 1 plus the expected 1 year rate a year from now. And remember, we're gonna take that to the 1/2 power because, of course, we'd technically be compounding the 2-year rate for 2 years. So let's just undo that by taking it to the power of 1/2. Now this is 1 plus the 1 year rate, so let's subtract 1 to get the rate itself, and there it is, 3%. So now let's see what the holding period return would be if we were to invest in the 2-year bond directly, or in the 1-year bond and then in another 1-year bond at the expected 1 year rate a year from now. And we'll see if those holding period returns are the same. If so, that should mean we're on the right track. Well, if we buy a 1-year bond right now, what is its present value? Well, remember, the yield to maturity is 2%, so the present value is simply 100 over 1.02, or 98.03. What is our holding period return? So if we are making a 1-year investment, and if we buy the 1-year zero coupon, our holding period return is, we end up with 100, we started with 98, and of course we get our yield to maturity because we did hold this zero coupon bond to maturity. But how else could we have made a 1-year investment? Well, what we could have done is we could have bought a 2-year zero coupon, and we could have sold it at the end of year 1, right? So let's see what the holding period return on that would be. First of all, what is the present value of this bond in year 0? What would we have to buy it for? Well, if expectation hypothesis is actually right, we should discount it at this rate that we got using the expectations hypothesis of 3%. So let's do that. Remember, the face value of the bond is 100. We're going to discount that at 1.03 for 2 years, of course, because it's a 2-year bond. And that is worth 94.25. Now, in a year's time, what is this bond going to be worth? Well, let's think about it this way. At the end of year 1, this 2-year bond now has 1 year to maturity. It's going to pay off 100 at the end of year 2, and what is the expected discount rate that will prevail at that time? Well, it's this one, right? 4%. So what is the present value of the 2-year bond at the end of year 1? Well, we're going to discount its face value. We're going to discount it at the expected discount rate at the end of year is expected to occur at the end of year 1. And we're only going to discount it for one period, 96.15. So that is what we should expect to be able to sell the 2-year bond for at the end of year 1, because the yield is now going to change and we expect it to be 4%. So what's the holding period return in this case? Well, we ended up with 96.15. We started with 94.25. And we see that in this case, we also get a 2% holding period return. So this looks good. A 1-year investor will in fact be indifferent under this definition of the 2-year rate, according to the expectations hypothesis, between investing for 1 year in this 1-year zero coupon or for 1 year in the 2-year zero coupon. But we're not done yet, because what about the 2-year investor? What they can do is they can buy the 1-year zero coupon and then repeat at this expected yield at the end of year 1. Or they can buy the 2-year zero coupon and hold to maturity. So what's their holding period return going to be in either case? Well, let's do the easy one first. If you buy a 2-year zero coupon with a 3% yield, what should you expect to be your holding period return? Well, remember, you start, or I guess you end with the face value. You began with its present value, but you held for 2 years. So let's actually take that to the power of 1/2 to account for 2 periods of compounding. Subtract 1. And indeed, our holding period return per year is 3%, which is what we would expect, because that is the yield to maturity on the 2-year zero coupon under the expectations hypothesis. Now, what would happen if instead we bought the 1-year zero coupon and then we held that to maturity, and at the end of year 1 we reinvested at the expected rate of 4%? Well, we can calculate it this way. We can say that in the first period we make 2%. In the second period, we make 4%. Now let's take the geometric average of that to account for the fact that we're compounding over 2 periods. Subtract 1. And that, of course, also gets us 3%. So that's good. That means that whether we want to invest for 2 years or for 1 year, and whether we do it with a 1-year or a 2-year zero coupon bond, we will actually get the same holding period return, meaning that this expression for the 2-year bond yield makes sense. That's the value that actually makes investors indifferent between any of these investment options. If it weren't the case, then they would actually be able to generate an arbitrage trade, because one of these options would be preferable to the other. You could lend at one, invest in the other, That would, of course, cause yields to adjust, so you would actually end up converging to identical holding period returns anyway. Now, what would happen if the expected yield a year from now went from 4% to 6%? Well, according to the expectations hypothesis, we should then actually have the 2-year zero coupon yield right now go to 4%. But let's see why. Let's do a proof by contradiction to see why the yield of 3% no longer really makes sense. So let's say you're a 2-year investor. You've still got those same options to either buy the 2-year zero coupon. Of course, that would get you the 3% yield, assuming that that still stays that way. Let's see if it does. Or if you follow the other strategy, you buy for 1 year, the 1-year zero coupon, and then you reinvest at the expected rate, which is now 6%, what would you get? Well, you would get, of course, 3.9%. So that would make this strategy of investing in the short term for 2 years superior to the strategy of investing in the long term just once. That means that a savvy investor would probably want to borrow at this 2-year rate, and they'd want to lend at this rate, making essentially free profit. That would actually push down the 2-year zero coupon bond's price and push up its yield. And of course, we can sort of see where this is going. Where would the appropriate equilibrium price of the 2-year zero coupon be? Well, it would be at whatever price makes sense for this yield. So if we discount the bond's face value at 3.98%, that bond should then have a price of 92.49, and then the holding period return actually does make sense again. Now the investor is again indifferent in investing in the 1-year bond and rolling their investment over for another year, or between investing in the 2-year zero coupon bond straight away. They would earn the same holding period return regardless. Now what about the 1-year investor? Well, we know that the spot 1-year rate hasn't changed, so they can still only earn that 2%. But what would happen if they instead bought the 2-year zero coupon and held it for just 1 year? Well, we know that the price of the 2-year zero coupon right now in equilibrium would be 92.5. What would its price at the end of year 1 be? Well, remember, now the discount rate has gone from 4 to 6%. So now its price is 94, and the holding period return is actually 2% as well. So that makes the 1-year investor indifferent between the two investment strategies as well. So you can see sort of how equilibrium forces will actually restore, or I guess how arbitrage will restore equilibrium, even if we perturb the expectation of future interest rates such that investors are again indifferent between investing in one or the other bond at one or the other horizon. So we conjectured that the typical shape of the yield curve under the expectations hypothesis is flat, but now we can sort of see the intuition for why that would be. Because essentially investors, by their trading, make it so. The expected holding period return for different time horizons, whether you invest in the short term twice, or if you invest in the long term and hold to maturity, it's actually the same, which is analogous to the yield curve actually being flat. Okay, hopefully that makes sense. So let's then talk a bit more about the shape of the yield curve. So remember, generally when we talk about the slope, it's going to be the 10-year yield minus the 3-month yield. So in about mid-2009, this was toward the end of the financial crisis, but still during a period of recession, we actually see a positive slope. Now, why would that be? And what is actually a positive slope of the term structure of interest rates telling us? Well, as we were in a recession, the Federal Reserve lowered interest rates from a relatively high level in 2007, 5%, to 0 in 2008. And of course, generally by lowering interest rates, the Federal Reserve hopes to stimulate the economy by lowering the cost of capital. If we think about that supply-demand model from the financial assets discussion, this is essentially lowering the cost of capital, therefore hopefully stimulating demand for capital at this new lower price. But at the same time, if growth is actually going to pick up, if demand for capital does shift out, that means that in the future, interest rates and therefore the price of capital can be expected to go up. Therefore, an upward slope, remember 10-year yield higher than 3-month yield, reflects the idea that long-term rates are expected to be higher than short-term rates. Now what about just a little bit before that? At the beginning of 2007, this is before the financial crisis, here we actually see a negative slope of the term structure of interest rates, negative 54 basis points. Remember, a basis point is a hundredth of, or I guess you can think of it as 0.0001, a hundredth of a percent. So this means that the 10-year yield is actually below the 3-month yield. So why would this be, and what does that mean? Well, before the financial crisis kicked off, the US economy was actually doing quite well. Remember, the financial crisis largely was caused by a boom in the housing market due to this increase in securitization of potentially loans that ex post probably should not have been made, but loans that led to a lot of construction and a lot of home sales, which then, of course, led to an increase in GDP. But this leads to potential expectations of inflation as there's sort of more and more demand for money. Short-term rates were actually quite high. Remember, in the prior discussion in 2009, they fell from 5.25 to 0%. Well, the reason that they got there was because there was more and more demand for capital, which pushes up the price of capital. So, since the Federal Reserve has a dual mandate, one of the mandates is to monitor inflation, investors generally expected the economy to cool down for one reason or another, either through Fed intervention or through some other means. That would mean that interest rates would come down, so even though they were high right now, they were expected to be lower in the future. That would mean that the yield curve has a downward slope. And the implication is that there will be less demand for capital going forward. This doesn't necessarily mean that people were expecting a recession, but it could be consistent with that as well, because certainly in a recession, you will have a big decrease in demand for capital and therefore presumably a lower equilibrium interest rate. Now, indeed, there is actually a strong relation if we just sort of plot out some recent and even not so recent history. There's a strong relation between the yield spread and recessions. So remember again, the 10-year minus the 3-month yield. We see that whenever the spread falls, it usually precedes a recessionary period, which we color code in yellow, identified by the NBER, the National Bureau of Economic Research. So this doesn't necessarily mean that the recession will happen straight away. For example, here's a case of decreases in the yield spread, but ones that were not actually followed by a recession immediately. But generally, drops in the yield spread, and especially negative yields, those are strong predictors of recession, perhaps with a little bit of a lag in this case, where the yield did go negative in about 1990, but the dot-com bubble didn't burst until about 2000. So there may be a time lag, but whenever the yield goes negative, that is certainly a strong warning sign that the economy is probably going to slow down, potentially drastically.